Welcome to our deep dive today. We're going to be looking at this fascinating story, really, about genius, ambition, and the hidden dangers of financial markets. The story of long-term capital management.
Yeah.
LTCM. You might have heard of it.
Yeah.
It was this hedge fund.
Right.
That kind of went from Wall Street darling to cautionary tale.
Huge cautionary tale.
Yeah, in just a few years. So we're going to look at what led to LTCM's spectacular rise.
Right.
And, of course, their even more dramatic fall.
Right. A lot of these stories, they really capture the complexities of the financial world.
Yeah.
And I think there are some really valuable lessons in here, even for those of us that aren't trading billions of dollars.
Absolutely, yeah. So where do we even begin with a story like this?
Well, I think we should start with the mastermind.
Go.
John Merriweather. I mean, John Merriweather is not exactly a household name.
Right.
But in the world of finance, I mean, this guy was a legend.
Okay.
Yeah.
Okay, so John Merriweather, kind of the man behind it all.
Yeah.
What was he like?
You know, he was a bit of an enigma. He was a cautious Midwesterner who found himself at the heart of Wall Street, rose through the ranks at Salomon Brothers. He wasn't flashy. You know, he didn't crave the limelight.
Yeah.
But he had an almost uncanny ability to spot opportunities in the bond market.
He was the arbitrage king.
He was. Yeah, that's a good way to put it.
I mean, I've always found that concept a bit tricky.
Oh, it is a tricky one.
Yeah.
So think about it like this. Let's say you found a rare baseball card at a flea market.
Okay.
And it's being sold for $5. But you know that collectors online are paying $50 for it.
Yeah.
That difference, that's where the arbitrager steps in.
Okay.
So they buy the card for $5, they sell it online for $50, pocket the $45 profit.
So with buy low, sell high.
Yeah.
But with a lot more complexity when we're talking about financial markets.
Yeah. Yeah, exactly.
Yeah.
And Merriweather was brilliant at this.
Okay.
I mean, he built a team at Salomon, the arbitrage group, that was essentially a brain trust. I mean, they had some of the sharpest minds in all of finance. These weren't your typical Wall Street types, though.
No. Like what? Like slicked back hair, suspenders? Not that.
No, not that.
Okay.
They were more like math whizzes, academics.
Yeah. I've read about these guys.
Almost out of place in that whole cutthroat world of investment banking.
Yeah, total misfits.
Yeah.
So how did they fit in?
You could say that, yeah. I mean, some people even called them freaks.
Okay.
They were fiercely loyal to Merriweather, though.
Okay.
And they formed this super tight-knit group within Salomon. I mean, they would play golf together, they would bet on everything imaginable, and they were incredibly secretive about their methods.
So it sounds like a bit of a secret society.
Yeah, kind of like their own little club.
Okay. But that secrecy, I'm guessing that probably caused some friction.
Oh, yeah.
With the rest of Salomon, right?
Definitely did. I mean, their success and their aura of mystery, it created this resentment, you know.
Yeah.
Among the other departments at Salomon, it was almost like they were operating in their own little world, separate from the rest of the bank. And this isolation, this tendency to operate in a bubble, it would become a recurring theme in the LTCM story.
It's interesting, you know, it's almost like they were foreshadowing their own future.
Yeah, you know.
Even back then.
Yeah.
So their success at Salomon, it was impressive.
Oh, hugely.
But it also kind of contained the seeds of their eventual downfall.
It did.
They were becoming too insular.
Yeah.
Too reliant on their own brilliance and perhaps not paying enough attention to the bigger picture.
Right, exactly.
And that bigger picture would come crashing down on them later on. But before we get to that,
right.
Let's talk about how LTCM was actually born.
Well, it started with a clash. Merriweather and his team, they were making tons of money for Salomon. But there was this controversial incident involving one of the traders that led to a clash with management. And Merriweather felt that his team was being unfairly targeted. And ultimately, they decided to leave and strike out on their own.
So they took their arbitrage magic and went independent.
Exactly.
But why a hedge fund?
Ah, that's a good question.
Yeah.
So hedge funds back then, they were like the Wild West of the financial world. They operated with less regulation than mutual funds, and they could utilize much riskier strategies. Things like using massive amounts of leverage to amplify their bets.
Okay, leverage. So basically borrowing money.
Yes.
To make bigger bets.
Yes.
More reward, obviously, but way more risk
Way more risk.
if things go south.
Absolutely.
All right.
And LTCM was all about leverage.
Right.
They believed that with their superior intellect and their sophisticated models, they could manage that risk and generate those outsized returns that hedge funds were known for.
Okay. And they had the star power, though, too, to attract investors.
Oh, absolutely. So remember those Nobel Prize winners?
Yeah, Merton and Scholes, right?
Yeah. They joined LTCM.
Wow.
Their presence alone was huge validation for the fund's strategy.
Yeah.
And it attracted billions of dollars in capital.
Okay, so you have this dream team of financial geniuses. You have a revolutionary strategy. Yeah. And more money than you could have ever imagined. I mean, it seems like the perfect recipe for success.
It did.
Yeah.
And for a while, it was. But remember those seeds of their downfall we talked about? Well, they were about to sprout.
Okay.
Yeah.
I think that is a great place to leave it for now.
Okay.
We'll be back. And in part 2, we will see how those early successes, that leverage, that secrecy, and maybe a little bit of hubris, started to pave the way for LTCM's spectacular collapse.
Right.
We left off with LTCM just riding high, attracting the best guys in the business, pulling in billions. But as we all know, this whole thing takes a pretty dramatic turn.
Yeah, it does.
When do we start to see the cracks?
Well, at the beginning, their strategy seemed to be working perfectly.
Yeah.
They were exploiting those tiny little price differences in bonds, particularly in emerging markets like Italy, and just making a killing.
Okay.
It was almost like clockwork.
But they weren't just relying on their smarts, were they?
No, absolutely not.
There was that whole thing we talked about with leverage.
Right.
Were they kind of pushing that to the limit?
Oh, yeah. They took leverage to a whole new level.
Okay.
Remember, we talked about repo agreements?
Yeah.
Those short-term loans from banks?
Okay, yeah.
Well, LTCM was notorious for negotiating incredibly low haircuts on those loans.
We talked about haircuts before.
Yeah.
But remind me.
Okay.
Why was that such a big deal?
Imagine you're borrowing, let's say, $90 against a $100 bond.
Okay.
That $10 difference.
Yeah.
That's the haircut. It's basically the bank's way of protecting itself, if the bond's value drops.
Right.
But LTCM, though, I mean, they were so confident in their models, so convinced they couldn't lose, that they often refused to pay those haircuts. Or they got them reduced to, almost nothing.
So they were basically saying, we're so smart, we don't need your safety net.
Pretty much, yeah.
Thanks, but no thanks.
And for a while, it seemed like they were right. They were generating incredible returns. Their partners were becoming incredibly wealthy. And their reputation, as these financial wizards, it just grew with each passing quarter.
I mean, but isn't there that saying, the bigger they are, the harder they fall?
Right.
It seems like it would apply here.
Oh, it definitely does.
Yeah.
And fall they did.
Yeah.
The first cracks started to appear in 1997.
Okay.
LTCM was starting to have trouble exiting some of their large positions. It was a sign that liquidity, basically the ease with which you can buy or sell an asset, was starting to dry up in certain markets.
So even though their models were telling them one thing,
right,
the real world was kind of showing a different picture.
Exactly.
Yeah.
It was a very subtle warning sign that the market wasn't behaving, quite as efficiently and rationally as their models predicted.
Good.
But instead of heeding this warning, LTCM doubled down.
Oh, wow.
They actually expanded into even riskier areas like equity arbitrage and derivatives.
Right.
And using even more leverage to boost their potential profits.
So they were essentially making a huge bet on their own brilliance.
I mean, you could say that.
Even when the market was flashing some pretty serious red flags.
Yeah, I mean, they really believed in their models.
And remember that secrecy we talked about? I feel like it's coming back to bite them.
Oh, yeah, definitely did.
Yeah.
They were increasingly reliant on Wall Street banks for financing. But their unwillingness to share details about their strategies
that makes sense.
Created this distrust.
Yeah.
I mean, the banks were lending them billions of dollars.
Wow.
But they were starting to get a little nervous.
So it's like they were playing this high-stakes poker game.
Right.
Refusing to show their cards even when the stakes were getting higher.
Exactly.
Yeah.
It's a good analogy.
And all this is going on. And their former employer, Salomon Brothers, was doing the exact opposite.
Right.
They were diversifying.
You're right to bring that up. Yeah. I mean, while LTCM was concentrating their bets, Salomon, after being acquired by Travelers,
Yeah.
they were actually diversifying their portfolio,
Yeah.
spreading their risk across different markets.
Okay.
It was almost a direct contrast to LTCM's strategy.
Isn't that ironic, though?
It is, yeah.
I mean, the student, LCCM in this case,
yeah.
is sticking to this one rigid approach while the master, Salman, is adapting to the whole changing landscape.
Yeah. Yeah, it's interesting how that worked out, isn't it?
Yeah.
And this difference in philosophy would really have a profound impact on their fates.
Okay.
While Salomon kind of weathered the storms that were brewing,
Yeah.
LTCM was about to face a hurricane.
Oh, boy.
But before we get to that,
Okay.
we need to talk about another crucial element of LTCM's story,
Okay.
and that is their unwavering faith in their models.
Hmm.
And of course, the men who built them.
And those men, they weren't just brilliant, they were Nobel Prize winners.
Right.
You would think with that kind of recognition, you'd be at least a little bit cautious.
You would think.
I mean, it's almost mind-boggling to think that even with a Nobel Prize,
Right.
these guys at LTCM just kept believing in their models.
It really is. It's a fascinating psychological aspect of the story. I mean, you have these incredibly intelligent individuals at the very pinnacle of their field.
Right.
And yet they were seemingly blind to the limitations of their own models. They were working with these incredibly complex mathematical formulas.
Right.
But, you know, those formulas were based on historical data,
Okay.
on assumptions about how markets behave.
And markets, you know, we all know they can be incredibly unpredictable.
Oh, absolutely.
I mean, influenced by emotion.
Right.
By things that no model can really foresee.
Right, exactly.
So they weren't prepared for, like, black swan events.
Yeah, and that's where this concept of fat tails comes in.
Okay.
It's this idea that extreme events, the ones that fall outside the normal range of expectations, they're more likely to occur than those traditional financial models predict. And LTCM's models, for all their sophistication, they didn't adequately account for these fat tails.
So they were essentially underestimating the potential for things to go really wrong.
Yes, exactly.
And one of their biggest bets, I mean, a bet that would ultimately prove fatal, was on equity volatility. They believed that the volatility of the stock market, that degree to which prices fluctuate, would decrease.
Right.
So they were essentially betting on calmness, on predictability.
Pretty much.
Which, I mean, come on.
I know.
But of course, the market had other plans.
Of course.
Like it did.
In 1998.
Okay.
The Russian government defaulted on its debt. And that sent shockwaves through the entire global financial system.
Wow.
It was a classic fat tail event.
Okay.
One that LTCM's models had not anticipated.
And I'm guessing they were heavily invested in Russia.
They were.
Okay.
And as investors panicked, they started fleeing risky assets and seeking the safety of U.S. treasuries. And LTCM, with its massive leverage and concentrated bets, was caught right in the crosshairs.
It must have been just absolute chaos.
It was a perfect storm.
Yeah.
Those credit spreads that they bet on narrowing started to widen rapidly. Their positions started hemorrhaging value. And the banks that had been so eager to lend them money suddenly came knocking, demanding more collateral.
Wow, so they're losing money at an alarming rate.
Yeah.
Their reputation is just crumbling before their eyes.
Right?
I mean, what did they do? They must have been scrambling.
It was a classic liquidity crunch.
Yeah.
They desperately needed to sell assets to cover their losses.
Right.
But the market was in free fall.
Yeah.
I mean, it was almost impossible to find buyers at that point.
Yeah.
It was this vicious cycle. The more they sold,
the
further prices dropped, and the deeper their hole became.
I mean, so what did they do?
Well, they tried everything they could.
Okay.
I mean, they reached out to wealthy individuals, to other hedge funds.
Right.
They even reached out to Warren Buffett, seeking a lifeline. But, you know, their past secrecy, their arrogance, the sheer scale of their losses, it had kind of poisoned the well. No one wanted to touch them.
So they were trapped.
Yeah.
Their models had failed. The markets turned against them.
Right.
Their investors were nowhere to be found.
Pretty much.
I mean, it's a crazy story.
It is a wild story.
Yeah.
And, you know, it wasn't just LTCM that was in trouble. I mean, the potential collapse of this giant hedge fund with its web of interconnected trades, billions in borrowed money, it threatened to destabilize the entire financial system.
Wow.
It was a scenario that the Federal Reserve, the very institution tasked with maintaining stability, could not ignore.
So the Fed, they stepped in, they bailed them out.
They did.
No.
It was a very controversial decision, a $3.6 billion bailout.
Wow.
Orchestrated by the New York Fed.
Okay.
And funded by a consortium of Wall Street banks. Now, a lot of those banks, they'd actually been burned by LTCM.
Right.
But they understood that allowing this behemoth to collapse could have triggered a financial meltdown.
It's incredible to think that a single hedge fund,
Right.
even one run by Nobel Prize winners, could pose such a threat.
I know. It's crazy to think about.
To the global economy.
It really is.
Well, I think it's a reminder that, even the smartest people can make mistakes.
Absolutely.
And that, models are only as good as the assumptions that they're based on.
They are,
And that risk, no matter how cleverly we try and disguise it, can never be completely eliminated.
It's always lurking out there, somewhere.
And that is the story of long-term capital management.
Yes, it is.
An absolute cautionary tale.
It is.
Thanks for joining us.
Thanks for having me.